Mid-caps gain even as frontline stocks see profit booking. FMCG metals are the big drags while industrials and utilities clock some gains.
British American Tobacco has trimmed its holding in ITC to under a quarter with sales via block deals worth over 13,000 crores. The sale will help BAT deleverage a part of its transformation plan.
LIC reports a good fourth quarter, expects double-digit growth in FY26 with improved margins. The chairman tells CNBC-TV18 and OFS may be in the works to improve liquidity in the stock.
Federal Bank MD and CEO Krishnan Manian tells CNBC-TV18 savings account rates can drop to 2.5% from 2.75% if RBI cuts rates by 50 basis points. He sees MFI stress continuing for 1 or 2 quarters and expects RBI's draft gold loan norms as a positive for the bank.
Noted economist and former RBI Governor Raghuram Rajan tells CNBC-TV18 this could be India's moment if it lays out the red carpet to draw FDI with proactive policies. He adds that the consensus view of US moving down may be wrong, even as he expects a reset of global portfolios.
A very good afternoon. You're watching Halftime Report on CNBC-TV18. I'm Ekta Batra and with me is Mangalam Malu. Well, it is turning out to be a session which is a little mixed at this point in time. While the mid-caps are faring better, we do have the Nifty, which is sulking a little bit, so down around 0.3% as we speak currently for the Nifty, and the Bank Nifty absolutely flat. As always, it's a lot about specific stocks today as well. So, for example, we have stocks such as ITC, which is in focus on account of that large block, but separately, we do have stocks such as Techno Electric, which is buzzing on the back of numbers, so that stock should come up for you up around 11% odd. MedPlus is doing very well in today's trading session, again on the back of numbers. Dynamic in focus on the back of what was a sluggish set this time. And separately, a lot of stocks in focus on account of what they would be releasing. So SAIL, IRCTC, Cummins India, to name a few. So definitely probably going to be a busy day in terms of numbers. But overall for the markets, consolidatory trend continues. Hi, Mangalam.
Consolidatory trend indeed. The good part is that the market is behaving in the range that, the Nifty has made for itself. 24,700 at the lower end to about 25,050 at the upper end. And that's what it's been meandering between over the last few trading sessions. Your portfolios feel a lot better. 1,500 stocks advancing for about 1,100 stocks which are declining. So for the second day running, the advanced decline ratio also in favor of the gainers. If you look at a couple of other stocks as well, the ones which are actually seeing some traction, Bharti Airtel is one of them. Yesterday we had Rajiv Jain of GQG say that he's added that stock in his portfolio. Muthoot Finance is the other one which is moving to the high point of trade. And alongside that, we've seen some traction in names like Ashok Leyland as well. Typically, CVs and agri-vehicles should do better on account of earlier than expected monsoons and perhaps better than expected monsoons as well. And today, we are seeing some traction in a lot of these auto ancillary names as well. Precision camshafts, for instance, up nearly 15% as we speak. And Bellrise was a good listing. That stock too, holding up with gains. LIC is the stock which is surging in trade today. The performance has exceeded street expectations. Management too guides for double-digit growth. Yash caught up with Siddharth Mohanty, who is the MD and CEO of the company, to discuss their performance gone by.
Last year, AP was almost flat. And primarily due to product regulation changes, Q3, that has great impact on our business. If you see past 6 months, up to Q2, we were showing very high growth. And we were to surpass our budget. But due to product regulation changes, our field force, they take some time to adjust to new product regulation, and many products were also redesigned, refiled.
Correct.
So that affected our AP growth. AP was just muted flat. But current year, FY26, we have taken directional change. We have given direction WRP and AP, that will be our target, not a total premium target. And last year, because of product regulation change, most single premium policies, our agents sold maximum single premium policies. So that also affected AP to some extent. But current year, I am very confident what figures show now. You will also observe after 1 quarter. It is in right direction and will show good growth rate in AP.
Okay. WRP as well as AP. Good growth is what you spoke about. What could be that good growth? Could it go back to about mid double digit?
Our objective is to at least achieve double digit growth in a WRP and AP.
Okay. Now coming to the elements of APE as well, retail and annuity in terms of the term book as well as the annuity book. What is the growth that you expect there for FY26? Because those are the two segments which are picking up very fast.
You see, annuity as well as a term, both we see a great uptick. Because annuity today, our annuity rates are most competitive in the market. And a term insurance, people prefer LIC term insurance because they are assured of whatever risk we cover will definitely fulfill our commitment. So I see good growth rate in both these segments, term as well as annuities.
Okay. Could you quantify? I mean,
it will be difficult, but whatever growth you are seeing, it will further improve.
Okay. I want to speak to you a little about market share also, because market share both policy wise as well as premium wise has declined in FY25. Policy wise, the market share declined by more than 4%. Premium wise, it declined nearly 2%. What is going to be the strategy when it comes to regaining that market share in FY26? Where do you see, what kind of increment do you see yourself making when it comes to the market share front from FY25?
You see, market share is a function of growth. The rate at which small players grow, it will be very difficult for LIC having a large base to grow at that stage. But having said that, we have our internal strategy. Up to a level, we must maintain our market share. We will not go below that level internally. Say for individual assurance, we are now focusing 40%. Okay. 2% plus this side, that side, but 40, it should not go below 40. Last time we achieved some 37 point plus something like that. So that is our strategy. But what we are focusing post-listing, profitable growth. Because after listing, every time I have given commitment to everybody that will show growth, profitable growth, that which we have already demonstrated in all our operations quarter after quarter.
Correct. So, I mean, if one has to understand the market share, both in policy and premium terms, in policies, your market share was 65.83%. In premium terms, it was 57%. Would these be the levels below which you would not want to go?
No, markets are difficult to predict, but this figure will grow. Whatever policies we sold last year, definitely current year we will achieve more policy. Because if you see, because of a change in product regulation, many policies ticket size has gone up.
Correct.
Minimum ticket size.
Correct.
And because many agents are rural agents, they confine only to small ticket size up to 1 lakh policy. But now most of the policies minimum sum assured is 2 lakhs. Correct. So that has some impact, but now they have adjusted over 1 year, whatever experience we have made. Current year that will be visible, so that more number of sale will happen and more premium also will happen.
Okay, so market share from this point is expected to go up. Okay, fair point. In terms of margins, that went up in Q4 to 18.75%. versus 17.2% on a year-on-year basis. FY25 margins, that came in at 17.6% versus 16.8%. You are growing your non-par book. That is a continuous process that you're making. But in FY26, you'll also have the implication of higher surrender value regulations coming in full force. For FY26, where do you see margins going? Do you think it could become the year where your full year margins, FY26 margins, could cross that 20-21% mark?
You see, last year we have already shown AP growth in non-par. Non-par share has gone up 27.69%. So, and also 80 basis point increase in our margin from 16.8, we have gone to 17.6. Current year, as I told, since focus will be on WRP and APE, and I am confident that margin will further improve. It will be difficult to quantify, but definitely at least from 17.6 to 3% uptick will be there.
Okay, so it'll cross about 20%.
Around that is our objective.
Now, let's speak about a couple of regulations. The government proposed the insurance amendment bill, the changes that it wants to see. One of those was to allow individual agents to tie up with more than one life insurance company. Now, for LIC, of course, the biggest, about more than 95% of the total business comes from individual agents. In that case, are you in favor of this particular proposal of allowing agents to tie up with more than one life insurance company, or are you against? And have you, whatever your view is, have you put that to the government?
You see, we have already made our view clear to government.
Which is?
And government will decide because the government is our promoter.
Correct.
And definitely whatever comes, LIC will face any challenge very effectively. We are well prepared. Any regulatory changes so far as open architecture, anything comes, LIC, and I believe my agents are not just agents. They are more than permanent partner with LIC because we give them so many other benefits apart from commission, unlike others. So I have firm belief whatever comes, our agent will be glued to LIC only.
Correct. But for this proposal, are you for it? Are you against
and we
it?
have made our view very clear because to develop a captive distribution channel, not only for any insurance company, but for any distribution company, it takes a lot of time, energy and cost.
Correct.
Because the captive distribution channel. And suddenly if you allow your channel, distribution channel to work for others, so that definitely poses some challenges.
Okay, understood. One question that I want to ask you, and this is with respect to certain comments which came from the DIPAM secretary as well. An OFS in LIC, that is in the pipeline. He is on record, mentioned it. 3.5% is the stake which is in the market right now. Do you think a higher float in the market will help LIC and a better price discovery of the shares of LIC? And second, since he's made that comment on record, have you received any communication with respect to preparing towards an OFS?
You see, this DIPAM will decide. So far as OFS is concerned, they will be deciding on that, and will be at appropriate time, will also be intimated.
Correct. But do you think a higher float will help better price discovery?
Definitely, because there is no float at present. If you see, unless there is a good float, difficult to trade. Because many people have asked me privately, we can enter, but how will we exit? There is no such float.
Correct.
So I think that will definitely help.
Okay, so have you put your view to DIPAM saying that we want a higher float?
They will consider. DIPAM is examining from all angles in the best interest of shareholders and LIC.
Okay, all right. So that's the management of LIC. We need to take a short break. But as we do that, there's some exciting news for you all. We're excited to unveil our brand new global business news channel, the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset and Global Lens at 8:30 p.m.
Welcome back. CEAT is one of the stocks which has moved to the high point of trade, so just keep an eye out on that one. Also, we're also seeing some traction in all the travel and tourism related stocks. So Thomas Cook, for instance, has moved to the high point, was in the red for most part of today's trading session, has now recovered from the lows, currently at the higher end of today's trading session so far. We had Juniper Hotels as well with a 9% uptick. And if you're looking at hotels and tourism companies, look at the platforms as well. yatraonline.com, for instance, is up about 4% from the lows and is in the green right now at the higher end of today's trading range so far. But the stock on our radar is Carraro India. Recent listing, the management joins us, reported a good set of fourth quarter numbers, but the entire year was fairly flattish. The margins came in healthy. The company said that indirect and direct export activity remains muted. Remember, that accounts for nearly a third of their revenue. So to discuss this and more, we do have Balaji Gopalan, who is the managing director at the company, joining in. Thanks a lot, Mr. Gopalan, for joining in. You've aspired to do 8 to 12% revenue growth in FY26. Could you tell us what are your aspirations across your verticals? Agriculture, you have construction and domestic, because you believe that exports are going to remain subdued. So if you could break your growth targets up for us across categories and geographies.
Yes, sure. Thank you very much for giving me this opportunity. Very quickly, we are looking at 8 to 12% growth in the current financial year. This is driven largely by the offtake of certain products that we have introduced recently. These are not based on the industry growth targets that we have. We are looking at the segment in which we operate, which is growing. For example, in agriculture, you can see that the four-wheel drive market is picking up in India. It was around 2% about 5 years back, 6 years back. The global average in developed countries is 99% four-wheel drive tractors. And in India, we are currently at 22%. 1 year back, 1.5 years back, we were at 15-16%. So the penetration of four-wheel drive market in the Indian tractor industry is gaining momentum, and Carraro is a dominant player in the four-wheel drive axle. We don't work in two-wheel drive and mechanical gearboxes. We prefer to get into the higher technology ramp up that is happening in the industry, and we are bridging the gap between what is there available technology in India with what is there globally. Carraro, with its 90 years of global experience and a legacy of experience in all soil conditions, we are able to give to the Indian OEMs a product of four-wheel drive technology that is well established and reliable and quick to market for them. They just have to pick it up from us, build the vehicle and launch it. So four-wheel drive is giving us a strong growth. We have acquired new businesses, new wins for the construction equipment as well in the teleboom handler business. This is at nascent stage, but we have got a very big contract of a supply leading to around 300 crores in 3 years. The ramp up has already started this year, and this is a fully export to one of the largest construction equipment player in the world. So these are some of the things that is adding up to my revenue and also to the export that we are targeting. All in all, considering the ramp up of four-wheel drive in India, the export that we have got for teleboom handler market, we are very confident of growing by 8 to 12%.
Okay. Mr. Gopalan, thanks very much for joining in. Just want to narrow in on this four-wheel drive in the agri segment. You said that it's increased from last year 15 to 16% of penetration to around 20 to 22% already. What are you projecting in terms of, say, FY26 and maybe 3 years down the line? And consequently, what would the revenue addition be because of this specifically?
Okay. See, we are not in a position to classify product-wise the revenue contribution that is coming in. It is a basket that we look at. But in any case, like I said, the four-wheel drive market is gaining strong momentum, and our target in the next 4 years, by 2029, we have a very strong commitment to reach 350 million euro. That is around 3,100 crore by then. And the factors that I explained, technology absorption is the kind of a go-to place for Carraro. And now the stage has come in India where the level of technology in the agriculture, that is tractors and construction equipment, is being absorbed very rapidly. And we are hoping for a kind of a pivot point where it will become very steep. Initial absorption seeding is taking place, and that is what is showing us result. 20% four-wheel drive in a market of tractor which is 1 million, 10 lakhs is quite a significant thing. And we expect this four-wheel drive to keep continuing to reach at least 40% in the next 3 years. And Carraro India is a dominant player. We have a significant market share of more than 60% in the four-wheel drive market. So that will give us the growth that we are looking at.
So from 20%, it increases to 40% over the next 3 to 4 years. You have a target that you've given for FY29 as well. Let's talk about the margins. Is there a differential between two-wheel drive and four-wheel drive margins? And you have a medium-term aspiration of mid-teens margin. Last year, you saw an improvement of 200 basis points. How much do you think can increase over the next couple of years? And by when do you reach that mid-teens target?
Okay. See, the growth in EBITDA is something that will happen step by step. Before going to that, I would like to pass the comment about the margin differentiation in agriculture and construction. Ours is a gearbox, ours is axle. The application is agriculture or construction, which thereby means that there is hardly a big difference between the margins. So margins will more or less remain the same. Two-wheel drive to four-wheel drive, Carraro is not into two-wheel drive. That is a very basic technology, And the fact that today we are doing well and the future is looking well is because of that technology change that is happening. And this will happen. If you ask me why am I talking about four-wheel drive growing more in India, that is because, as I said, the global average is 99% for the developed countries. In India, food security has become a focus area. We have to ensure food security, and for food security, the government itself is pushing for farm mechanization, farm efficiency. And the new trend that is coming into the Indian market is contract manufacturing in agriculture. To that reason, you need to take in four-wheel drive vehicles that can support farm mechanization. And that is the basis for us to evaluate and gauge and have a judgment that it will touch at least 40% in the coming years. Coming to the EBITDA growth, we are focusing on localization, which earlier was 67%. Today, we are at 77%. We should be touching 80% this year, and we are targeting 88%. Whenever we localize, we save a minimum of at least 10%, going up to 15% in the cost of procurement. Why didn't we do it till now? That is because the technology upgrade that is taking place, and that is the segment that Carraro specializes and works on. The technology was not available in India because there was no need for such technology. Now, with the growing market with higher technology, we are able to source it locally. International players have set up shop in India, so that is helping us in a big way in localizing. So that will add to my margin. We had in the past, royalty payment to our headquarters, but just before the IPO, we got 154 IPs transferred into Carraro India. Thereby, the royalty to headquarters has reduced dramatically. Third, we are giving a very strong emphasis on cost control. Fixed cost remains the same. My revenue grows, and that brings in the margin that I am looking at. So it's a combination of all these factors that will give us, together with sales mix. Higher the technology, it's a black box, and I am able to quote a higher margin for those products, and there is a demand for such products. So these four aspects together will give me at least a 1% increase in EBITDA year on year for the next 3 to 4 years. During this, we are working on all initiatives to maximize our margins.
All right. So we're going to leave it on that note. Thanks very much for joining in and giving us all of that perspective. So around 8 to 12% growth is what the management is expecting, and around a 1% increase in terms of EBITDA margins for the next 3 to 4 years is what they are estimating. Export markets a bit subdued, but they are focusing on segments such as the agri space with the four-wheeler drive segment. Well, that's on Carraro India. That stock just about lower by around 1% We'll take a short break. Up next, we'll get you more on the markets and the F&O cues today.
A big surge in Force Motors is what we're seeing. It's up nearly 5% from the lows. Perhaps some commentary coming in on four-wheel drives doing well in India has the stock excited. I'm not sure whether it's directly correlated. They are into the SUV manufacturing as well as some of the buses, etc. So you'll keep an eye out on how this one pans out. This month has been a good one, up 30% for that stock this month. But the market otherwise is behaving, let's put it that way. There is consolidation, but it's consolidation within those range. So if you look at the Nifty bank that has been, slightly muted just below the red line, nothing really to worry about. And when there is support which is expected at, lower levels, the mid-cap index is the one which typically outperforms. And that's exactly what is taking place for not just today, but 2 days in a row. The advance decline has been fairly in favor of advances, making your portfolios feel a lot better. 24,800, that's where the fulcrum is now. 24,800 call has a premium of 120 rupees. We have the 24,800 put coming up for you. That has a premium of almost 140 rupees. So put both of these together, you're looking at an expiry between 24,600 at the lower level to about 25,000 at the upper level tomorrow on the Nifty. But a bunch of stocks will be on our radar. Hindustan Copper and SAIL may enter F&O ban given the activity that we've seen in open interest out there. Now it remains to be seen how much of that is on account of rollovers and how much of that will be carried forward to tomorrow. So just as of now, it looks like they may enter F&O ban. And RBL Bank, which is in F&O band, the only stock in F&O band right now, may actually exit F&O band. So just keep an eye out on that one. RBL Bank may exit F&O band, while the others may enter F&O band. With that, we'll take a short break. On the other side, we have the management of Supriya Lifesciences joining in to discuss their performance.
Welcome back. You're still tuned into Halftime Report this afternoon. Well, it's turning out to be a session where we're seeing a little more traction in the mid-cap, so up around 0.3%. The advanced decline ratio is also holding in positive terrain. So we have around 2,100 stocks advancing to around 1,700 stocks declining. But we do have a lot of companies lined up. Supriya Lifescience is the next management on the show. It reported what was a good set of Q4 numbers. Margins came in healthy. The company says that they are seeing strong interest across global and specialty pharma segments. Saloni Wagh, who's the MD of Supriya Lifescience, now joins in to talk about the numbers. Saloni, hi, welcome to the show. If you could just start by talking about the margins, they've improved quite significantly to around 37%. What led to this margin improvement?
Yes, I think this year has been one of our milestone years, and we have given our best revenue as well as margins. Margins stood at about 37%, which is almost 260 crores of EBITDA. And I think the two main growth drivers for this is one, the backward integrated model that we have, and the other would be our penetration into more regulated markets. If you see our sales in regions like Europe, Latin American markets like Brazil, they have really gone up. I think that is the main reason why the margins have also gone up.
So in that case, what is it that you're likely to sustain going forward, and how much more revenue can you generate from regulated markets? If you could give us that quantifiable number as to this proportion comes now and say over the next 2 to 3 years, this is what your target is?
So currently, almost 50% of our revenue comes in from the regulated markets. Moving forward, I think a more sustainable EBITDA margin for us would be somewhere between that 33 to 35%, mainly because we are expecting new product launches in the next financial year. And we are also scaling up our finished formulation CMO division. So once that comes in, I think 33 to 35% would be a very stable EBITDA margin. Here, I would just like to mention, while you see a little compression on the percentage margin, in terms of the absolute EBITDA, absolute PAT, you're definitely going to see a good growth going forward.
Okay. Well, Saloni, I just wanted to narrow down a little bit on your top 10 customers. That still contributes to around 58% of your sales. You're looking to diversify that base. Tell us how you're doing it and by when we could probably expect it. And do you have that sort of target in FY26?
So actually, our top 10 customers today contribute to almost 50% of our revenue. But what you have to understand that in the top 10 customers, almost 4 or 5 customers out of that are large distributors. So these distributors in different countries are like the representatives of Supriya, and they stock our material and they cater to the small end users in those markets. So those 4 or 5 customers itself are catering to more than 100 customers globally. So as such, although it looks like 10% contributes to 50% of the revenue, as such, those in turn are catering to more customers. So it's already a very diversified customer base.
Okay. I just wanted to narrow down on, this entire semaglutide opportunity. Would that be something that you all are looking to, partake in, considering that it is going off patent next year in many emerging markets as well as India? How would you participate in that? Are you participating in that?
So peptides is yes in our R&D, not just semaglutide, but some of the other peptides also we are working on in our R&D. But those for us will come at least 2 years later for launch. I think some of the new products what we are launching in the next financial year mainly are therapeutic categories like ADHD. We also have cardiovascular. So these are anesthetic. We are also expanding our portfolio. So I think these are the therapies which would be getting launched in the near term. For the peptide chemistry, I think we are still 2 years away from launch.
So you're not going to be participating in the semaglutide opportunity as of now?
No, not immediately. I think our focus is more on how to strengthen our anesthetic basket. In Q4 of last year, we have already launched one of our products, which has a very large global market, almost 300 million. So I think we would want to focus more on that basket right now.
What sort of revenue growth are you penciling in for the next couple of years? And also, there was a project where you would be the exclusive API supplier for a CMO project in a European company, because you did say that 50% of your sales come in from regulated markets. To what are you looking to increase that to?
So we are expecting this percentage to go up to about 60% in the near term. As far as some of the new products are concerned, specifically that opportunity that you're referring to, it's actually an exclusive contract that we have bagged with a European company called DSM Fairmanage, where we are going to be their exclusive suppliers for a vitamin product for the next 10 years. And we are already seeing some commercial gain from that. At peak, I think this contract will give us about 60-70 crores of revenue. And we can expect that peak to happen in the next financial year itself. As far as the growth is concerned, I think we have always guided that in terms of revenue, we will grow 20% plus. And I think that's the guidance I would like to give moving forward as well. 20% growth in revenue while maintaining a very robust EBITDA margin.
When you say robust, what would it be? You did mention 33 to 35 is sustainable. So robust would mean what?
33 to 35%, in my opinion, is a very good, robust margin.
No, I meant, in comparison to FY25, where you closed at 37% odd, or your exit rate in Q4 was 37%. So 33 to 35 would be lower than that. So in that comparison, what do you suggest?
So I think one has to understand that the 37% margin is at a lower base. When you grow 20% plus in revenue, and I said this before also, although it looks like a compression in percentage margin, if I were to look at the absolute EBITDA value in crores, you will definitely see a very good growth happening there. So from here on, you can expect good increase in EBITDA, PAT, as well as the revenue.
And about these certain projects, for example, the CMO project that you have with this particular company to supply vitamins for the next 10 years, any more such opportunities lined up, any talks taking place as of now, which we could probably see materialize?
So 2 other opportunities are there, out of which one we can expect commercialization in the next financial year. We are also having a very large opportunity in the anesthetic space, which we are discussing with one of the multinationals. Of course, that will take about 18 to 20 months to commercialize. But we are aggressively working in the background on how we can strengthen our CMO, CDMO. Plus, once the Ambernath facility scales up, which is predominantly a CMO, CDMO site, larger such opportunities will come.
Right. And what about WHO? I remember you saying that in the past you've been looking to reduce your contribution coming in from WHO, and then there's always this hanging sword of news coming in where some sort of funding to WHO would be scaled back. Whether that happens or not, how much does that now contribute to your overall revenues, and has that seen any impact when it comes to the news flow around?
No, I think it doesn't contribute much to our revenue even now. Like I said, almost 55% of my revenue is coming in from regulated markets like Europe and Latin American markets. And other than that, the other markets like Southeast Asian markets also, we have seen good growth. I think from 11% to 16% they have grown. So for us, I mean, they are not a really big revenue impacting factor, at least not in the short term.
Okay. Well, Saloni, before we let you go, I just wanted your sense in terms of an API manufacturer. What are you seeing in terms of trends on the larger scale? On one end, we do have the US, which is in talks with China for the entire trade agreement. So do you think that the opportunity for a 1+ manufacturer in India is still as strong? And separately, considering what is taking place when it comes to tariffs and onshore manufacturing in the US, how would that play out for a company such as yours?
So I think any good manufacturer who has the right kind of regulatory approvals, who has a backward integrated business model which is sustainable moving forward, who has good focus on EHS, aspects, I think they definitely stand to benefit from the China Plus One strategy. At least we have benefited a lot from this in the last 2 to 3 years. With the US, I think for us personally, it contributes a very small portion to our revenue. So we have to sort of wait and watch, because some of the new products what we are launching, they have a very large market in the US. But I'm hopeful with the bilateral trade agreement which is going on between India as well as US, things would streamline. And I still hope, and I'm very confident that Indian manufacturers who have all these right aspects in terms of regulatory and sustainability, they will still benefit a lot from the China Plus One strategy.
All right, take that point, Supriya Lifesciences. That's the management of Supriya Lifesciences. Saloni has joined us. Thank you so much for your outlook. 20+% revenue growth with increased contribution coming in from regulatory markets, and you have 33 to 35% margin guidance as well. With that, we'll slip into a short break. And as we do that, here's some good news for our viewers. India's business news leader is now just a click away. That's the new CNBC TV18 app. You can get instant access to breaking news, in-depth articles, interviews like this, what we did right now, all of that at your fingertips. You can download this app from either the Apple Store or the Google Play Store. Or if you just don't want to do that, scan the QR code which is up for you on the screen, and that will redirect you to the link that gets you to this app. Welcome back. Triveni Engineering, that's the stock that is gaining in trade on the back of their fourth quarter earnings. We spoke with the management as well. Ria joins in with more on what she made of the management commentary and the numbers. Ria.
Well, Triveni Engineering has been trading higher in today's session after reporting its results yesterday. Taking a look at the revenue first, that was up over 9% on a year-on-year basis, which was driven by strong revenue growth across its sugar, alcohol and power transmission businesses as well. In terms of sugarcane crushing, the company has achieved crushing at almost the same level as the previous season, but the gross recovery was lower by around 69 basis points. All of the sugar units of the company's the operations have been switched to C-heavy molasses from B-heavy in the latter part of the season. In terms of profitability, the segment profits for the sugar business declined by around 12.8% over the previous year due to the higher cost of sugar sold during the year. Looking at the alcohol business, the profitability was adversely affected in this segment as well due to the low margin maize operations and lower sales volume of ethanol produced from molasses as well. But the power transmission business this time around has performed very well for the company. The turnover is up around 26.8% over the previous year, and the profits are also have increased by around 18.4% compared to the previous year, and even the order book has gone up by around 35% compared to FY24. So this is one segment that has performed very well for the company.
All right. Thanks, Ria, for that. We'll take a short break. On the other side, Manisha will join in. She has with her Ajay Goyal of Wheat Products Promotion Society. Stay tuned.
Welcome back, and joining us on the show now is Mr. Ajay Goyal. He's Chairman WPPS. Mr. Goyal, thank you so much for joining in. And there have been various reports suggesting that the government procurement, which is almost at 30 lakh tons now, is where we could see it now capping at perhaps. What is your own sense?
Yes, I think, the procurement activity has almost come to an end, and so have arrivals. And so we're just at the threshold of 30 million tons, and just about a very small number to get that round number of 30 million, but we are almost there.
And the targets of 31.5, do you see that meeting at all? I mean, do you see a drag? Do you see it going above that, or do you think this is it now?
I think this is it, more or less. And I think the target of the government was quite ambitious, and that was primarily fulfilled because of bonuses declared in MP. And if you notice that originally the target in MP was 6 million tons, but looking at the arrivals and the procurement, because of the 175 rupee additional bonus, they raised the target by 2 million tons. And that's also almost there, like you have almost 7.8 million tons in MP. So MP has largely, and MP and the bonus, and so has Rajasthan assisted in bringing in near about 2 million tons. So I guess 30 million tons is a good procurement for the government.
With that, Mr. Goyal, now is there more clarity on what is the kind of crop that we are looking at? Because when you look at the USDA numbers, the government numbers, the industry and trade numbers, they still quite stand varying in that sense.
So I think one thing common between everybody's stand is that this year's crop is about 3 to 4% higher than last year's crop, whatever everybody's number has been. And that is quite evident in the procurement and in the early arrivals that you will notice. So I guess the number is about 4% higher than last year's number of different various data collectors.
Mr. Goel, there are various reports that, and this is something that we've been hearing from the government as well, that once the procurement is done and the private trade has had its fill as well, is when we could be looking at some limits coming in. Are you hearing anything of that sort? I know it's too early, or it's perhaps preempting it, but are you hearing something at all?
So I think there are 2-3 aspects to this. Number one is the rumor mills in WhatsApp never stop working. And again, today, there are highlighted reports that there would be a stock limit of 3,000 tons on trader. And one trader commented that there should be a permanent stock limit on traders. There's no point removing the limit for a month or two. But I guess the government is quite comfortable. If anything that is lacking is clear direction of policy. The markets, we are continuously playing a game of dumb charades with the government, and it's high time that the government realizes that and comes out with its clear-cut intentions or policy for this year, because the government has almost fulfilled its target of 30 million tons. And I think the only thing that moves this market is policy whispers that keep coming in. Otherwise, there is sufficient wheat in the marketplace.
What about the private trade? Because we, in my conversations with you and the rest, the other industry also suggests that the private trade has had its fill as well. As compared to last year, the government has sufficient holdings, and the private trade is quite comfortable as well.
So I think this year, the private trade and government both have more or less fulfilled what they intended to do. And UP is a surprise pack because there was no bonus in UP. And if you look at UP's procurement or into the government kitty, it's, I guess, around 1 million tons, which is, considering it is the largest producer. So the stock is in UP. And that could, fulfill the market's needs in the coming months. And plus, there's the hope of government releasing its excess quantities at some point of time. So I guess it's a comfortable situation.
What is also your sense about the wheat product exports? I mean, this is a time that the government said it would start reviewing that too.
I think, the government wants to make itself very comfortable, not bring in any triggers for a price rise, and wheat product exports could become a trigger for that. But definitely the industry is clamoring for atta exports. As we all know, atta is a uniquely Indian product used by the Indian diaspora. And there is a need for the government to look into it because, a lot of money has been spent, effort has been made to create the marketing network, the distribution, the logistics, the entire supply chain. And for 2 years, it's quite a rigid policy to import wheat, to export atta for people who have created that marketplace. So we are still hopeful that the government at some point with some restrictions will open up wheat atta exports on a quantitative restriction.
What also is your sense on prices from here on with the in light of things that we've been talking about, enough a good production, a bumper crop, enough inventories with the government, with the private trade as well? Where does that leave the prices then?
So I think the prices currently, if you consider the bonuses paid by the government in MP and Rajasthan and the base price, are ruling in tandem with that. So it's about 2750 in Delhi, which I feel is like the appropriate price considering the government's bonus in MP and Rajasthan. So we are around the same price levels at which the government has procured. And I think now it will be demand that will take over the price scenario. If we have a very strong demand in the coming few months, you will definitely see markets move up a bit above cost of carry.
That was my next question, really, on what is your sense on the demand going forward? Because, yes, we have good stocks, we have a great crop, and with the kind of monsoons that we have, perhaps the next season would be quite positive as well. But what about the demand?
So I guess as far as demand is concerned, large users are covered. Everybody has taken from a 40 to 60% hedge in terms of physical stocking, the large pan-India players. But demand is, expected to go up, move up in the coming few months if the weather, as we have early monsoon. So definitely we would see a spurt in demand in the next 15-20 days.
What is the average increase in demand growth that we have seen collectively for wheat and wheat products in India?
About 1.5%, I would say.
And that has been ongoing for a decade, would you say, or there's been a move there?
No, so it's quite flattened now, but definitely during Corona times, sales of noodles went up. Otherwise, the biscuit industry has had a good run where biscuit demand was going up by almost 7-8% per annum, but that's almost 5 or 7 years ago. But there are new segments where demand is high. But overall, the total quantum of demand, I guess, is about 1 to 1.5% per annum moving up.
And the production increase has been to what tune?
So production has kept pace. This year we have caught up well for whatever additional demand we have. So I guess this year we would be a slightly surplus year. Even last year was a surplus year as far as government stocks are concerned. But of course, the price levels were a bit high.
Point taken, Mr. Goel. Thank you so much for joining in. So strong numbers coming in from wheat there. Couple of factors. One is to watch is on what do we see in sense of product exports. And the second is whether or not the government brings in any restrictions in sense of holdings there. Mr. Goel, as always, thank you so much for joining in. And with that, that's all the time that we have on the show. Business Lunch will take all the action ahead.